welcome to an earlier edition of Hung Chin Hon Sweatin Money. We may or may not have ownership or other positions in the stocks mentioned on the show. Don't buy stocks based solely off what you hear from this podcast, and always do your own homework and research before investing in stocks. I'm your host, Kong, along with my co-host, Gibson. Let's take a look at what's in the news. Last week we mentioned this article where Line went online with their IPO, and I made a mistake. I thought it would go on the market on our Friday, and then it would be like a date earlier in Japan. But it turns out Line's IPO went public on our Thursday, which is their Friday. So in the past 2 days, while their initial offer was well above their asking price, it's been falling ever since, and overall has fallen 10%. I'm very sad at the fact that I made this mistake, and on both days I didn't wake up early enough to set up some puts, so I could have profited from this greatly.
That's true. 4%.
No, that's just 4% in the last day, but
10%.
Overall, yeah, 10% in the past 2 days.
Nice.
Yeah. So yeah, too bad. I'm thinking actually there's still room for it to fall though. So if I wake up early enough tomorrow, we'll see. Yahoo on Monday, this coming Monday that is, will be Yahoo's earning announcement, and it's going to be crucial for the pricing of its company, for their potential sale of their assets to other companies. Now, some analysts believe it's worth holding on to. Yahoo stocks are worth holding on to just for the sale itself. What do you think?
I don't know. I mean, Yahoo's a bit of a staple. It's been here for a while, but then again, I don't know how it makes money anymore.
Yeah, I mean, they've had this tough time trying to transition itself from a sort of like purely search engine sort of thing where they can't beat Google's algorithms to, I mean, they tried to transition to an entertainment company, and I mean, you know, for the couple of years where they were trying to duke it out with Google, they couldn't figure things out, and then they finally gave up on that end, and they tried to work on the whole media aspect. But I mean, you know, you're trying to fight Netflix, Amazon Prime, Hulu, and YouTube, which is also owned by Google. I mean, you're kind of screwed.
Maybe they could pivot into becoming like a incubator or something, like Y Combinator. YC.
I see what you did there. Yeah, I don't know. I mean, I don't even know if they have anything that's worth other companies really buying aside from their shares in Alibaba, really.
I don't know. I mean, I feel like maybe they still have some sort of share or web traffic, so that still has some sort of value.
I guess, but we'll see. Now, whether or not you're an investor, you're still making Social Security contributions, America's form of retirement money for the elderly, thanks to Franklin Delano Roosevelt's New Deal. Every election season, you'll hear the scare about Social Security running out of money, but this Forbes commentary says it's nonsense because it's only a matter of whether or not we are willing to increase taxes to fund Social Security. So then the question is, why are politicians so eager to cut its funding? Well, it's the petty belief that people who are no longer productive to the economy are receiving free money that's subsidized by other working members of the workforce. Okay, fair enough, but according to this AARP report, this money that old people spend goes back into the economy. So thanks to old people spending money, it actually keeps the young, quote unquote, productive workforce members employed by offering services. What do you think?
Makes sense. I mean, old people spending their money before they die, they're like, it's a given, right? You don't want to go into the grave with a ton of savings.
Right. But, oh well. That aside, you have Honda, whose shares I still own, I think, has come up with a new hybrid motor that doesn't use heavy rare earth metals. Not only does this make the engine lighter, it also makes them less vulnerable to price fluctuations and manipulation from rare earth metals that they buy from China.
That's good news.
Yeah. Now, some good news actually coming out from China. The GDP numbers for the second quarter came out, and it was actually slightly higher from the prior year. The government has been pumping out credit into the industrial sector and has it's fueled fears of further stimulus and unsustainable debt, in the country. So, however, there was less credit pumped into the second quarter. So because there was less need for credit, plus consumer spending was actually up slightly and was more significant as part of China's GDP. So the likelihood of further stimulus is low, saving worries of further burgeoning the Chinese economy with further debt. So, I mean...
That's great news.
Yeah, I mean, it seems like maybe China is going to transition into that consumer-based economy that everyone hopes for, but we'll see. After the UN's ruling over the Philippines, sorry for that map, the Philippines had a suit against China for their giant swathing claims of most of the South China Sea. Now you can check out the competing lines on that map right there. Now, without boring people with all the technicalities and stuff, the ruling was that China's claims were unsubstantiated. That didn't stop a man from attacking another man in China because he was wearing a pair of Nike shoes. He was saying that his wearing of a foreign brand's products meant that he didn't love his country enough because, they think that this is some sort of U.S. plot, even though it was a UN ruling. Anyways, like the article's author said, maybe it's time to switch to the domestic Chinese sports brand Uncle Martian, as we had talked about previously.
That way, they don't know if it's a foreign brand or not. Uncle Martian or Under Armour? I don't know.
One of those.
As long as it's not my keys.
All right, and so in a never-ending search for yields, equities and stocks have only seen about 6.5% gain this past year, considering all the ups and downs the market has experienced. So it brings us to the bull market you haven't seen, this Bloomberg article. In times of volatility, many people plow money into bonds, diminishing return rates for bonds, because obviously they're stable and there's so much. So, I mean, time to lower the yields, I guess. So in some countries, Japan and like several Euro countries, you've already seen implementation of negative interest rates, but yet people are still buying their bonds. So why is that? So because it also means that these bonds are so safe still, even with these negative rates, more and more investors are buying into them, specifically because the rates to buy into these bonds are much higher per share. So it's still driving up the prices of the bonds themselves. So what you're doing is you're kind of playing bonds like stocks, but you're hoping that if you can sell it off, you can still make enough so that the penalties that you'd have to sell off aren't going to be that significant. I mean, it's kind of crazy.
Yeah, it's kind of like a gift and good. Kind of the economy gets worse, and then the shittiest, lowest price thing gets more expensive.
Right. Now, on to other bonds. The IRS is about to come out with a new way to tax convertible bonds. So what the heck is a convertible bond, you may ask? Well, basically, it's a corporate bond that is directly tied to the price of the company's stock. So if the company's stock price goes up, you can convert your bonds to equity or stock shares, and you actually make money. Also, if the bond price falls, you can sell and convert as well as to try to recuperate those losses. So by doing so, you're protecting assets, but also because these are bonds and not equity, the taxation policies are a bit different, which is why the IRS wants to change it up. You can get more information from the Financial Times video explaining the changing face of cocoa bonds, as they call them. And major financial firms like Goldman Sachs and Morgan Stanley just got an extension to sell their billions in private funds in compliance with the DoddFrank Act, which has provisions discouraging risky behavior amongst bank and financial institutions. Specifically, they didn't want companies like Goldman Sachs and Morgan Stanley to which are firms that own government-backed deposits from speculating over private hedge funds and equity funds.
That makes sense.
Yeah.
I mean, the bigger the player, the bigger the waves, right? And they don't want them to just cause huge like turmoil in the market. So
right. So I mean, if they're given another year, I mean, do you think that this is a time to look at what specific funds they may hold, and then see if we can maybe try to short them, or what?
Pretty valid. I mean, if they have to sell, then those prices, they're going to drop dramatically. Yeah. I mean, you could guess where they're shorting it, then yeah, you stand to make a lot of money.
All right. So how do we find out what private funds they hold?
You can look into a site called like Whale Wisdom, or just analyze their the company's 13F, which is basically a disclosure on what shares they hold.
Yeah.
Yep.
Okay. Let's take a look at the week in review. The Dow Jones was the only index to continue making gains all 5 days of the week. So in total, they gained about 2.02%, while the others are still on top. They kind of lost a bit of ground on Friday. The S&P was up overall 1.48% for the week, and the Nasdaq was up 1.45%. Monday international markets. We're going to skip this section because it's too much to edit, and I need to do some things for tomorrow early in the morning. So let's go ahead and skip to investor sentiment today. Overall, investors are bullish about the stock performance this week, but the survey ended on Wednesday, so it doesn't take into account the last 2 days of the week, which were kind of like they were looking like they were about to slip. So this may become lowered. The investor sentiment, that is, it may be less bullish next week. So let's take a look at the playbook. Just again, a reminder, none of the following should be misconstrued as financial or investment advice. This is merely provided for documentation only. Pretty much all my investments are back in the red when you include fees, except for Dunkin' Donuts, but with that, I'm barely up 20 cents. So, I'm assuming the same situation is for you for Disney, right?
Yeah, although I think my short on Caesar is still in the green.
Right.
Yeah, everything else, I mean, it's slowly creeping back up. China's economy stabilizing. You know, there's like a lot of global concerns that were part of like why everything's been depressed. One of them was just China's economy, and another thing is Brexit. Another thing is Brexit. Another thing is that you're like the oil prices and OPEC and so on. I feel like a lot of these concerns have been largely addressed, or they're not as impactful as everyone feared. So I think it's just a matter of time before everything picks back up again.
Right.
So relatively not too concerned.
Alright, well, we're going to skip recommendations for today, and I think we're quite good for today. So thank you for listening. Just once again, we may have ownership of the positions of the stocks mentioned on the show. Don't buy stocks based on which your friends podcast. Always do